Deep value is an investment strategy known as buying business disasters. It is simple, but it's counterintuitive idea. Under the right conditions, losing stocks with apparently falling businesses and uncertain future offer usually favorable investment prospects. Joel Greenblatt conducted an experiment in 2002 to see if a computer can be programmed to invest like a Warren Buffett. Greenblatt is a value investor and a Columbia University professor, has a long history of research and writing about value investing strategy. Greenblatt proposed to test a Buffett wonderful companies at fair prices as a quantitative strategy. Wonderful company was measured by return on capital, while fair price was determined by earning yield. Over 47 years tested from 1964 until 2011, portfolio with 30 stocks with the best combinations of earning yields and return on capital would have returned 13.9% per year, comparing to 10.5%. For a market, the magic formula outperformed the market by 3.3% annually. The magic formula has outperformed, but what driven the returns to the magic formula? Is it really mimicking the Buffett's wonderful companies at fair prices strategy? Finding the first-class businesses with the first-class management? Or is it something else? Eager to know. Toby devolved the magic formula into two parts: return on capital and earnings yield, and tested each independently over a full data period. The results were astonishing. Earnings yield alone was returning about 18% annually, while the return on capital was turning around 10% annually. Because of the earnings yield, the magic formula is so powerful. It beats the market consistently. Return on capital was pulling back earnings yield. That's why earnings yield alone is such a superior metric. Greenblatt's earnings yield, known generally as the enterprise multiple, occasionally as the acquirers multiple. Enterprise multiple can be simplified and calculated as follows. Enterprise multiple equal EBITDA or EBIT divided by enterprise value. Enterprise multiple outperform any metric out there, so the strategy is to choose a portfolio and find the stocks based on enterprise multiple metric. The more depressed the company, the better the outperformance. Also, portfolio should have around 20 stocks. It's considered as well diversified, and there is really no benefits to buy more stocks than 20. Portfolio should also be rebalanced every year. So this was a summary of the book Deep Value Investing by Toby Carlisle. It was an amazing read. I highly recommend to any investor, especially if you're a value investor. So if you guys have any question, please comment below, and thank you so much for watching.
Welcome back. My next guest is the author of a book called Deep Value, and what he promises to show you is how to identify a company whose intrinsic value is miles greater than the share market price. This is the holy grail for people playing the stock market. So is Toby Carlisle really Sir Galahad? He joins me in the studio. We'll find out. How are you, mate?
Well, thank you, Pete.
I hope you're old enough to realise who Sir Galahad is. He was the guy who was looking for the Holy Grail. Of course, Monty Python told everybody that. Okay, so here's the book, Deep Value, okay? Nice colours, nicely done. Tell us what the principle of the book is all about.
So I looked at the things that purchasers of entire companies seek out, which is what value investors try to do, try and buy the entirety of the company. So I looked at what do big institutional investors do, like private equity firms, activist investors.
Real buyers of real businesses, not shareholders.
Right, so what do they look for?
Yeah.
The things that they look for are very cash-rich balance sheets, strong operating earnings, and a depressed valuation, a very depressed valuation.
Okay. So, and we're talking about something which is called net, what is it? Give us the net current asset.
Well, there are two rules that I provide in the book.
Per share. Net current, yeah.
One of them is this net current asset value, which was the thing that Benjamin Graham, who was the founder of value investing, he wrote about that in 1934.
So in simple terms, you just take the current assets, which is like cash, and all the good stuff, debtors and all that sort of stuff. You take away your total liabilities.
Yes.
Right?
That's right.
And you divide it by the number of outstanding shares, and that gives you a figure.
Yes.
Okay.
And then you need the market capitalisation to be 2/3 or less of that figure.
Okay.
So very, very few companies pass that
test. Okay. Right. So, why is this such a good test of a company?
They're very, very undervalued at that stage. You're really not paying for the business at all. It's purely balance sheet valuation. So you're getting terrible businesses when they're that cheap.
So you say most of these businesses are crap businesses?
They're terrible businesses. They're priced as if they're going to the woodshed.
Okay.
They're sub-liquidation value.
Okay. But you're saying these are still buyable?
They are. They're very hard to find.
Okay.
They're very hard to dig up. But when you can find them, statistically, in the States, in Australia, globally, they've returned about 30% a year compound for a very long period of time.
Before we go any further, just in case you're just a hoaxer on the business speaking circuit, you're going to pull your face off at the end. What is your background? Why are you interested in deep value?
I was a corporate attorney before I was an investor. And one of the things that I sometimes saw was activists battling for control of companies that were in the doldrums.
Like Carl Icahn and people like that.
Exactly like Carl Icahn. And it was sort of difficult to understand as a lawyer why they might want what looked like a pretty ugly business. And so I discovered value investing, Benjamin Graham, Warren Buffett, and they explain this sort of process to you. And the idea is that you're going to find mispriced businesses when they're in the doldrums like that because nobody wants to buy them. That's really the best time to buy them.
Okay. But then obviously it's a gamble. Are you arguing that through reading your book you reduce the chances of making a big mistake?
Well, you have to understand one thing. These things are more likely to go to zero than the average stock. They're about 2.5 times more likely to go to zero. So the average stock in the stock market goes to zero. 2% of them go to zero every year. 6% of these will go to zero. But as a portfolio, they outperform the stock market very consistently, and they've done so over the long term, even though this metric is very well known.
Is there a fund manager who actually creates a portfolio like that?
There are lots of them. I'm one of them.
Oh, you're one of them. You just happen to be promoting your own fund. Fair enough. I didn't realise that. But how many companies do you put in this fund?
Well, the optimal number is 20. This is something I've done a great deal of research on. It's somewhere between 20 and 30.
I always go for 20 in my portfolios, but go on.
20 is the number that I think is the optimal number, but you can buy as many as 30 if you can find them. They're very hard to find. So I actually favour a slightly different metric that is much more scalable. It's called the acquirer's multiple, which is the old enterprise multiple, very similar, slight variation on that. And it looks for exactly that, very cash-rich balance sheet, strong operating earnings in relation to a depressed business price.
Some people at home listening to this, Toby, will say, if someone's company's got a cash-rich balance sheet, why is the share market so negative on them?
Well, there are examples out there right now. So,
do you want to name one?
Sure, Mount Gibson Iron.
Okay.
I think that's undervalued. It's got $500 million of cash on its balance sheet, $600 million market capitalisation.
And it's been clobbered because of the iron ore price.
Exactly right. So if you tell somebody that you're going to buy an iron ore miner.
Tomorrow, some people are going to buy Mount Gibson on the strength of this, but I guess your argument would be, well, that's the reason.
As a portfolio, as a position in the portfolio,
yep.
If you do this statistically, you're going to come out ahead, but you have to be consistently doing it. It does underperform some years. Any individual position can underperform, but as a portfolio, they have beaten the market for a long period.
Like, for example, you name Mount Gibson. Have you had a real good look at the company as well? Apart from the fact you look at the balance sheet and it's cash rich, have you looked at other aspects of the company?
So, I favour not diving in too deeply, and I know that
like
sounds
crazy.
Buffett
does your bit and dives in deeply and goes management assessment and stuff like that.
There's some good behavioural research that says that when you dive in too deep, you get distracted by these other things, and these are terrifying businesses. Iron ore might be at the very beginning of a big swan dive. It's a terrifying sort of business to buy, difficult to buy. So the best thing to do is to focus on a metric that really does work and has been proven to work. And there's a lot of research that I discuss in the book. I worked with a gentleman from the Booth School of Business, which is the best quantitative business in the States, the old Chicago School of Business. And we analysed 50 years of market data, pushed through a lot of fundamental analysis, and that was the metric that outperformed.
Okay. So, is there a well-known company in Australia that fitted that bill, where it looked like a complete write-off, and then totally turned it around?
Well, globally, I think Apple.
Of course, Apple was. When its share price was what about $5?
It got down to $3.88. So Apple features in my book repeatedly because it was a $7 net in 2002. It was a $700 stock.
And I got to say, I used to deal with Apple as a small business writer and stuff like that, and they were the worst. You know, you didn't want to work with them because the attitude was terrible. The product was always great, Apple product, but the attitude of people here on the ground was terrible. In fact, I even remember it. You know,
they're always going to be businesses that you don't like, and that's really the secret to finding mispricings. If you sort of get the gag reflex going when you're trying to buy this thing, or you feel the fear, then you know you're on the track of something that's potentially.
But how can you be assured that you don't end up with an ABC learning? Because there was a great company, and all of a sudden it was terrible. Would that little summary of current assets minus total liabilities just chase you off? Because they carried a lot of liability, if I recall.
So that's likely to be one that won't pass. It won't be in the screen ever. And I distinctly remember my dad owned it at the time, and I tried to talk him out of it. Didn't believe me. Broker talked him into it. And we know how it went.
Yeah, most definitely. Okay, so how long has your fund been going for?
The US version of it launched in 2012.
Okay, and what's it called?
Equum Investment Management, and the fund is Equum Fund LP.
Okay, all right. So, what other little things that do you need to know? Because people have got those books, and often they find them very technical and they don't understand them.
Yes.
So try and make it easier for the people who are going to struggle with some of the quant stuff in there.
Right. Well, like I said before, the thing that you really are looking for is the cash-rich balance sheet. And the reason that a cash-rich balance sheet is very important is it gives them time to work through the problems. So you want not just cash balanced by debt, you want more cash than debt. And then what that gives you is a residue for the part of the business that you're actually paying for, which should be less than the market capitalisation. That little sliver is called the enterprise value. And then you want very strong operating earnings in relation to that small enterprise value. And those things have worked really well for a really long period of time. That's the best performed metric.
Okay, and I should explain to people who are watching this that you do emphasise you need 20, because in there, what percentage or what number do you think of that 20 could even disappoint you, who should be pretty good at working out the company's worth having a punt on?
I work on about 1 out of the 20, so about 5%, 5 or 6%. But what happens is they tend to cluster. You get a bad year when everybody has difficulty getting access to financing, and they might struggle a little bit. Or they've got something off balance sheet, and the fear, the bogey monster that everybody's worried about really actually does turn up and take that company down. So that does happen.
Toby, what about the cycle itself? Like if you came on my show say April 2009, and about 3 or 4 months before that, I was telling people that I thought the market was going to go up, and when it did go up in March, I think my hair loss slowed down. That would have been a great time, I guess. There would have been a lot of mispriced businesses because even the market was just treating everyone terribly. What about now? Do you as a cycle goes on, there are a lot less mispriced businesses?
Yes. So I've said before that March 2009, that was running through fields of clover for guys like me. You could just you could pick up anything, and it was a good buy.
Yeah.
Now we're at cyclical lows of those sort of positions. There's about 3% that pass my very deep value requirements now, versus sort of in 2009 it was about 40% would have passed.
What you must have had a memorable one, which really either shocked you on the high side or disappointed you on the low side.
I've had a few, but I had a position in a company that attracted some activists who wanted to bust out the cash, and it was a 70-cent stock with $1.50 in cash.
Right.
And they were trying to get approval.
Is it America?
In America. They're trying to get FDA approval, which nobody thought they'd get. And then they got it, and it went from being a 70-cent stock to being a $7 stock.
Yeah.
So in that instance,
That's
the analysis was wrong, but it worked out well.
Okay. Flip side?
Happens all the time.
Yeah, because you are dealing with some tricky companies. So, what do you think is the biggest mistake that investors generally make? Because obviously you looked at your dad's approach, and he's probably more like a normal investor, and you've decided to take the road less travelled. So, what are the big mistakes you think people make?
The primary one is getting too excited about a business that's very popular at the time. So in the States it'd be a Tesla or something like that.
Yeah.
All that they're looking at is the business and forgetting that the most important driver of returns is valuation, not business performance itself. So what you really want to find is something that's very cheap rather than something that you think is going to perform very well.
Yeah. So lots of these companies that are estimated on their future potential, they just don't pass your test at all because they haven't got much cash. Their earnings are really low. You wouldn't even enter them into your analysis.
And the problem is that everybody knows about them at the same time. If every man and his dog thinks that one particular stock's going to go very well, it really has to outperform even more than it has to go better than everybody thinks it is going to go for them to make money, and it happens so infrequently that you're more likely to lose money.
Okay, is your fund an American fund, or do you don't do an Australian?
But I have separately managed accounts, and I can take money from Australians.
Okay. Take money from Australians? Probably not the best.
It's always your money.
That's
when it's
right. Manage your account.
It's not
without doubt. So we should say it's called Deep Value. Publisher is Wiley, but where can people buy it?
Amazon, Barnes & Noble, and you can occasionally get it from the Wiley website, but it's sold out a lot.
Okay, so it's an online place to go. Mate, thanks for joining us on the show. Good luck with it, and I'll be reading it in my holidays. Great stuff. After break, Michelle Bridges joins us to reveal how she's building a brand set to stand the test of time.